All right. Good evening, everyone. My name is Greg Mullaney. I'm joined here this evening with Chris Pylant, new CFO for Somnio Wealth and CPAs, and he is helping us on a lot of different fronts, but more importantly, helping you with a lot of tax planning. He's been here with us for a little over 3 months. Glenn hasn't gone anywhere, won't be going anywhere anytime soon, but he's adding some horsepower definitely to our sister separate tax firm, Somnio CPAs. Also with us this evening is Peter Pagano, who has been with us as an advisor for 3 years. So I know he is probably very familiar to most of you on this call. But he is also the one who's going to be fielding questions and answers. You'll see on the screen right now, it says, if you have any questions, to please email peter.pagano@somniowealth.com. Uh, fortunately, we're in a regulated business that requires us to document all electronic communications, including this webinar. And as a consequence of that, we have to have that done outside of the chat feature that's disabled. And we'll take those questions. So as they come in, Pete will accumulate them, and we'll wrap things up at the end with Q&A. So moving along, tonight we're going to be covering a lot. You've heard about this One Big Beautiful Bill Act. We are giving you a One Big Beautiful seminar. And sometimes you might hear it as OBBBA. We're going to call it OBA or OBBBA. We're going to talk about individual tax rates. We're going to talk about deductions, estate planning, tax breaks, investment incentives, and other changes not a part of OBA that just kind of coincidentally do relate to some tax planning, and then close out with some Q&A. So with that, I'm going to pass it over to Chris, and you'll be hearing from all three of us here.
All right. So what is OBBA, as we like to affectionately call it? This is a legislation that was signed into law by President Trump on July 4th of this year. There's several changes and additions made to the bill, including many provisions of the 2017 Tax Cuts and Job Act that were made permanent, such as the income tax brackets and the child tax credit, albeit a little bit differently. Several new tax breaks, deductions, and credits have been introduced, including one that temporarily increases the standard deduction for folks that are 65 and over. And we'll get into each of these in a little bit more detail as we move through this. The bigger thing that I just want to mention before we go through this, there's a lot of detail in here, and the impacts are going to, of course, vary quite a bit for each person, each household, each business. So we would just encourage you, to have a conversation, right, with your advisors, your wealth advisor, your CPA, and really understand the impact that all of these different components, may have on you and your family. All right. So with that, there are five major components that are covered in the bill. So as mentioned, the individual tax rates, the seven brackets that were created in 2017 were actually set to expire at the end of this year. They have been made permanent. So we will not see any, changes to our income tax rates just based on those. Several changes to deductions and credits. The big one that I'll expand on more here that I mentioned is the additional standard deduction for people 65 and over. That's $6,000 each person, so each individual. So married filing jointly could be an additional $12,000. And that's on top of either the standard or an itemized deduction, either route you go. This does have income phase out rules. And so for individuals, that begins to phase out if your income is over 75,000 and completely phases out at 175,000. For married filing jointly, it begins to phase out at 150,000 and then completely phase out by 250,000. And then one item to note as well, this is also unfortunately a temporary benefit. These are set to expire at the end of 2028. There's also another one I'll just mention here real briefly, and then again, we'll get into detail on each of these. There's a new charitable deduction for folks who do not itemize. So 1,000 for individuals, 2,000 for married filing jointly. These are for cash-based charitable contributions that you can claim and get deduction for on your tax bill, even if you do not itemize the rest of your expenses. All right, and the state planning and wealth transfer. Some good changes here, including higher exemption amounts for estate and gift taxes. There are a lot of tax breaks for businesses, some that are just kind of made permanent, and then some that are new, and we'll get into those. And then finally, some investment incentive programs that we'll cover in more detail as well.
Sorry, on mute again. Uh, the TCGA or JA individual tax rates are permanent. I want to repeat that. A lot of our discussions with clients, who some of which are on this presentation, some of you are not. But for the last 2 years, we've been doing some modeling and tax planning, showing you how much your taxes were going to go up next year when the old tax code, the TCJA 2017 legislation expired at the end of this year. What the OBBBA did is it made that permanent. This is a win for most people. The brackets will continue to be adjusted for inflation. Coincidentally, the IRS is today or yesterday, it was in the news today, announced that the lowest two income tax brackets, so if you're in the 10 or 12% tax bracket, that was actually indexed for a 4% inflation factor. So at the end of the day, the 12% tax bracket for a couple is now all the way up to $100,800, or half of that if you're a single filer. If you're above that tax bracket, the 22% and above brackets all were indexed going into 2026 for a 2% inflation factor. How does the government do this? I don't know. We just blame it on the IRS. We're just here delivering the news. But that's hot off the presses. So if we go to the next slide, what does this mean for you? There that it provides a people who are nearing retirement or in retirement, which are most of you on this call. It provides a lot of opportunity to actually do some planning. We don't see these brackets changing substantially over the foreseeable future, given the political environment we're in, and just the fact that these have been made permanent through 2028 to 2030 and beyond with some of the deductions. There's a great opportunity to look, particularly if you're going to be between the 12% and 22% income tax brackets, or have some years where we plan for you to be in a low bracket and some to be in a higher, to take advantage of some of these deductions. And there's literally some opportunity to look at, do we do a conversion all in one year? Do we do some of it in one year? At the end of the day, a lot of unique opportunities for us to model. It's the first time since I've been in the business where we've known the tax code before the end of the year. To that, I just want to point out, if you don't work with our Somnio CPAs, or you don't work with us yet, we talk about the difference between tax planning and tax preparation. Tax planning is what we're doing right now. We're talking to our clients about what they should be doing between now and December 31st, because that's preparing your taxes. That's preparing to prepare for your taxes, excuse me. Tax preparation is really tax compliance. That's what Chris gets stressed out about, and Glenn gets stressed out about between January 1st and April 15th. You are getting, when you walk into their door, you are getting the most diluted version of them you can get. Now, they're really weird and they get excited about doing all that work in a very small period of time. But at that point, 2025 has already happened if you're walking into their office next spring. There's not much advice that can be delivered around 2025 planning. So our advice to most people is now is a great time to be planning. How much income do we want to recognize this year versus how much do we want to recognize in future years? And are there any other opportunities that you might want to take advantage of? With that, I'm going to kick it over to Pete.
Hello, how are y'all? Sorry, my video should be on now, but I had a little bit of kid snafu, so I'm in my car trying to manage both children and also work. Um, but I just wanted to talk about the changes to deductions and credits and go over some of the permanent and temporary changes that have been done. So some of it does apply, some does not, but overall, I think it's great to know exactly what is out there and available. So if it's not for you, it might be for your children or others. Some of the permanent changes that have been made is that the standard deduction now has gone up. It's 15,750 for a single filer, 31,500 for a joint. And that is also going to be that's starting in 2026 for the 2025 tax year. And each additional year, it's going to be indexed for inflation. So it should keep up with, not fully, but at least have some margin for inflation as it moves forward. Um, Again, that probably doesn't pertain to you, but for 2,200 per children, also inflation adjusted. Mortgage, if you still have it, there's a limited amount to 750,000 of debt for the first 750,000 for the interest on that. Their home equity loan, if you were to take one out and do home improvements, that would actually be deductible, but they are no longer letting the interest from other ones that don't really increase the value of your home as being able to be deducted. They made the changes permanent to the clean vehicle and energy credits. That's eliminated after 2025. But they are going to allow you, if you're buying a U.S. manufactured vehicle, there are some advantages surrounding that. Um, for charitable giving, this is probably the most relevant for you all. There's deduction is now up to 1,000 for a single filer, 2,000 for a joint. Um, and this is we want to make sure that when you are doing the charitable givings, particularly if you're taking RMDs, that we're making sure we're capitalizing on that as opposed to just trying to itemize it. So itemizers, their deduction limit is to their contributions of 0.5, a half a percent of income, and that's to benefit the 35% tax bracket. Some of the temporary tax breaks that are coming in, now these are temporary, so they're 2025 to 2028 in most cases, and one to 2029. Again, this is for hospitality workers. There's no tax on tips up to 25,000 or overtime at 12,500. This is where the car loan interest is deductible, providing it's a U.S. made vehicle. So I think the idea is here to make sure that we're trying to help create jobs as well as manufacturing here in the United States. And this is another one that's good, is that you can have an extra $6,000 of standard deduction for seniors at 65 and older. I'm sorry to say and lump that some of you are in this, but it is true. If you are over 65, there's a big advantage there. So, and then that's about what I would say pertains to you as retirees, which is predominantly what we have on this call.
Okay. Um, you've accumulated all this wealth. How do we move it to the next generation? Um, I have to be perfectly honest. A lot of these numbers are big, and this is a low change. Currently, the gift tax exemption and estate tax exemption are linked. You have the lifetime benefit or at death to give away up to $15 million per person, $30 million per couple. That is portable. What do I mean by that? If one of you passes away and your estate is somewhere between 15 and $30 million, um, and your estate it grows after that, you can actually use the unused portion of your deceased spouse so that if you're the second to die, you get the full benefit of the $30 million. It's not like a use it or lose it at the first passing. Um, that um, is for a lifetime or at your death. So what do I mean by that? Uh, a lot of you are familiar with the annual exclusion amount, totally separate, change subjects from the 15 to $30 million. The annual exclusion amount says that you can give anybody and as many anybody's um, up to $19,000 a year, $38,000 if you're a couple. So you have a son or daughter or a loved one or a niece or nephew or somebody you want to benefit. You want to give them some money to help them buy a car or buy a house, do whatever. If you're married, you can give that person $38,000. What a lot of people don't understand or don't necessarily know is that you can give them a heck of a lot more than that. In fact, 15 or $30 million right now and not have to pay any tax at all, and they won't either. The trick is you have to file a gift tax return for any amount above that annual exemption amount. And what you're doing is you're reducing your lifetime gift exemption or estate tax exemption. They're linked, remember. So if you give away, I'm making the math easy for myself. If you give away $138,000 today, to your son or daughter as a married couple, you're going to say 38 of that was part of the annual exclusion amount. The other $100,000, I'm going to file a gift tax return. Again, it's just reportable, it's not taxable, and it's going to reduce your gift tax exemption in the future and your estate tax exemption from $30 million to $29,900,000. So, the point of that is if you need to help your kids or loved ones, this tool allows you to do it. This didn't really change. The amounts went up just a little bit relative to these really big amounts. I think it was like $1.5 million increase, but at the end of the day, you can fact check me on the exact amount. I just know it's 15 million and $30 million going forward. And it's adjusted for inflation. The other thing, and perhaps the biggest pitfall we see retirees make when they're talking to their moms and dads who might be in their 80s, 90s. We have some clients with parents that are over 100 who have accumulated these assets that have appreciated a lot. They'll come in the door, they'll be so excited, and they'll say, "Hey, yeah, my mom and dad just wanted to make our lives simpler so that we didn't need to process any paperwork or deal with probate." And they turned their house over to us before they died. Unfortunately, what they missed is what is still permanent in this bill. It's a step up in basis. It's been preserved. So think mom and dad are in California or even here in Louisville, Kentucky, some houses have gone pretty wild. Mom and dad acquired that house for $50,000. Yeah, maybe they made some improvements over the years, and now it's worth $100,000. Or if they put 50,000 in, their basis is 100. 50 they bought it, 50 of improvements, but the house is worth $400,000 or $500,000. Well, there's a $300,000 to $400,000 gain in that house. if they gave you that property or that stock or bond or whatever the asset might be before they passed away, you now have the basis of whatever they paid. So you're going to have to pay the tax on the gain if you dispose or sell that asset. Instead, what we encourage people to do is take advantage of this step up in basis, which says if your mom and dad pass away and they still own the asset and you receive it, they get the benefit, the person that receives it at death gets the benefit of a new step up in basis to the date of death or 6 months after. Gets really complicated if I talk about the difference between the two. But at the end of the day, nobody pays tax on the gain if it's disposed of or sold after the date of death. So um, at the end of the day, the estate planning wealth transfer rules, they didn't change much, but they have been made permanent going forward, which means that we can plan with that much more confidence. And also know that just like everything else in this presentation, it's all subject to change again. So now is a great time to think about your giving plan and your wealth transfer plan going forward. Chris?
All right. So with that, I'm gonna jump in and talk about some new business tax breaks or extensions. So as you can see, from the slide, one of the biggest ones is the Section 199A, the QBI deduction. That's a 20% deduction for pass-through entities. Has been made permanent. So this continues to allow business owners, particularly smaller business owners, to deduct the first 20% of their income that's passing through to their personal return. For a nice tax savings. There's also been a nice change to R&D rules. So the 2017 tax law mandated that R&D expenses be depreciated over a 5-year period. And while the OBBBA still allows that, many domestic R&D expenses may now be fully expensed in the year that they are incurred. Another one that's actually not on the slide here is the 100% bonus depreciation has now been made permanent and even expanded to include additional expense categories. Now, I will note that that is effective as of January 19th of this year. And prior to that, the prior bonus depreciation schedule had already been declining. I think it was down to either the 40 or 60% level. So, there might be some things there. Don't automatically assume that everything that you've done in 24, early 25 is 100%. That need to have a conversation about that. But anything after January 19th of this year that qualifies in every other way it qualifies for the full 100%. Right. And then finally, the QSBS, or the Qualified Small Business Stock. And what this gets complicated, but what it essentially is, it's a tax benefit that incentivizes investment in startups and other early stage companies, by offering a substantial financial reward, let's say a tax benefit, by taking the risks of funding these ventures. And as you can see, there's some pretty big numbers involved in this. I'm not going to really spend any time on it here, other than to say if you're in this position, if you qualify for it, if you're looking for funding as a business, then that's definitely a conversation that I would recommend that you have with your advisors.
All right. So just quickly running through investment incentive programs. This is for kind of diversifying your portfolio and getting into REITs as well as real estate properties. Just some changes on how they're doing the opportunity zones with that, as well as C Corps. And so I'm not sure how many of our clients on the call are actually involved in real estate, but certainly something, if you're interested in getting in, that there's some advantages. So they're now doing the 10-year timeline again of if you're in an opportunity zone and you wait 10 years, then your gains you get a step up in basis, as well as you're getting you don't have to pay the gains up front, or actually get a tax deferral and also tax advantage on your growth of those. For a specialized in rural areas, you're going to get a 30% basis change in your investment. So again, to make numbers easy, if you invest 100,000 into a property, you can sell it for 300,000 after 5 years. That's a gain of 200,000 from there. But you can actually take that 30% and go from 100,000 to now your initial investment, as it's seen, is 130,000. So it helps limit in terms of how much you're actually having to pay as far as capital gains by helping your step up in basis. It's just an idea of trying to incentivize people on doing that. And if you have more interest in real estate, we'd be happy to talk with you individually about that and talk about diversifying your portfolio into that, and if it makes sense. I will say I've got a couple questions that have come in to my email, and if you don't have that, again, it's peter.pagano@somniowealth.com. And if you have any questions on the presentation we've been doing so far, just go ahead and shoot me an email with that question, and we'll do those shortly.
Okay. Pivoting off of OBBA and back to the Secure Act 2.0. Secure Act 1.0, I believe it was passed sometime in 2019, and changed a lot of things specific to catch-up contributions, RMDs, and all those sorts of things, but it left a lot to be desired in the way of needing clarifications. And so I just scanned the attendee list, and I've got good news that I'm talking to a lot of old wise people who are over the age of 50, with the exception of Haley, who works in our office as the only other participant under that age. In any event, many of you, if you worked or are still working, will remember that when you were employed working for a company that has a 401k, if you're over 50, you can make a catch-up contribution. This year, that's an extra $7,500 on top of the $23,500. And that tax savings on that extra $7,500, if you make more than $145,000 starting in 2026, is going away. So it means that if you want to do the catch-up, you're losing the deduction on that extra $7,500 catch-up contribution. You can still do it. You just have to do it on a Roth basis. So it's a penalty, for lack of a better description, for the higher income earners above $145,000. I didn't catch in today's IRS release if that's gone up a little bit, because everything else was indexed today. So that probably increases just a little bit next year, but not much. If you're between 60 and 63, there's what's called a super catch up. You get to do a whole bunch more, 150% more. If you're over $145,000 in income, that means you got to still do it on a Roth basis, but you can do more money into that Roth catch up bucket. Yeah, so that's it on the retirement planning catch up basis. If we go to the next slide, we've got some other changes specific to all these notices you might be getting from your employer about all these changes. There are things like if you're starting a new plan, there's got to be automatic enrollments, and you've got to have auto escalation clause. So we're seeing a lot of employers adopt that for new employees. So if you're late in the game in your career and you decide to change your job, you may be forced into automatically enrolling or automatically increasing your savings rate each year. These are generally good things, particularly for the younger savers. So don't necessarily apply to you, but you might hear some belly aching of a younger employee saying, I wasn't sure I wanted to participate in the 401k, and they were automatically enrolled. Your employer can now give you some incentives. I know a lot of retirees joke with us about showing up for the free steak dinner to hear our competitors talk. Your employers can now offer you similar sorts of benefits, some gift cards and things to get you to come to their annual education events. Um, there are some other emergency withdrawal options and hardship things. The biggest change that we think is the biggest benefit to the younger demographic is the maternity leave or maternity benefit. I forget the exact technical term, but it basically provides a hardship option to access dollars that somebody may have accumulated in their retirement plan in the event they have a child and need access to those dollars for whatever reason, if a baby's been born. Um, Roth rollovers. If you've got unused dollars in a 529 plan, I know this is maybe one of the biggest arguments against 529s is what happens if my kid doesn't go to school or we don't use all the dollars in a 529 plan. There are some rules that allow you to convert the 529 to Roths for that kid or your grandkids, but it has to be for a beneficiary. It can't necessarily be for yourself. Excuse me. And nothing materially changed on the RMD rules. If you're on this call or not, we've been talking to people about the RMD going from 70 and a half to 73, and it will go 75 in a couple of years. It didn't change anything to do with the qualified charitable distribution. So if you're over 70 and a half, as a general rule, Chris can chime in and provide the advice, but as a general rule, the best dollars to give away are those pre-tax RMD or up to $100,000, whichever is more until you reach that $100,000 limit. It is that's the best place to give to charity in most cases. So that rule is still there. It didn't change. And that one still is stuck at the 70 and a half year old IRA owner. Last thing is just tidying up. For whatever reason, there was an RMD rule for Roth 401k dollars. Unlike Roth IRAs, Roth 401k versus Roth IRA, the Roth 401k in the past, you had to take a minimum distribution from the Roth 401k, but you didn't if it was a Roth IRA. Going forward, Roth 401ks no longer have RMDs.
All right, so just kind of want to reiterate that, obviously we've covered a lot of ground in here, both in the OBBBA and outside of it or related to it. But again, there are a lot of components that will impact you, whether individually, as a family, maybe your children, and then of course for business owners. So, just again, we encourage you to talk with your advisors. If you do not have any, we certainly would love to fill that role for you. But really have this situation, or excuse me, your situation modeled out so that you can really have the best information for your wealth planning, your business planning, minimizing taxes, whatever the case is, all of the above, ideally.
Okay, great. Still only a couple questions, but there's still time if you want to send those in. I'll start off with our first question, which is how will the new law affect my RMD?
Um, it won't change the calculations. It won't change when you need to take it. If you were already phased into a 73 versus a 75, and just to clarify for those of you younger than that, because I know some of you are working, but basically the IRS says when you get to a certain age and you're no longer working, those dollars that you have in a pre-tax IRA account or pre-tax 401k account, a certain percentage of those have to come out.
3.78.
It's starting at 73 now. It used to be
Regular
70 and
plans,
a half. And
traditional.
go, going forward, um, it is going to be phased into people over 75.
Great. Sorry if you heard me talking over Greg. I have my son in the car, and I'm trying to also let him listen and learn a bit about traditional IRAs and the difference between the two. So, anyway, so another question is, how do I go about scheduling a meeting with my CPA or advisor and or advisor?
Yeah, I can take that, Greg. There's really a couple different ways. You can shoot us an email, you can give us a call, and we can steer you towards the right advisor for your needs, or possibly a whole group. Or you can go on the website and you can choose the type of consultation you're looking for and select the time that best fits your schedule.
Yeah, I'll just piggyback on that. With Glenn Barber, who some of you know, I started Somnio CPAs in 2019. And when we got into the business, just like with all of our other centers of influence or other professionals we work with, attorneys, CPAs, any consultants you work with, we're not in the business of disrupting relationships. We might be biased. We think our tax firm's pretty good. But at the end of the day, if you like your tax advisor or you like doing it yourself, we're going to work with you as we always have. But we're also going to have people like Chris and Glenn. When you ask us questions as your financial advisor and we don't know the answer to them, we're going to have Chris and Glenn and the benefit of them to help complement whatever that relationship is with that you have with your tax advisor, CPA, or self. And that's why we always talk about Chris and Glenn being our tax interpreters as financial advisors.
Okay, great. I do have one more question that's come through. It is, what kind of what if scenarios would I expect to have done in a tax planning meeting?
You take
Chris?
that one?
Yeah.
Yeah, sure. So it's really going to kind of come down to your individual situation, right? I mean, there's going to be the standard, where are you at income wise for the year? Where are you at withholding wise? Are you having enough withheld to pay your taxes so you don't have any nasty surprises? Do you have opportunities to put more money away, to enhance your retirement portfolio? But it could also be more specialized situations. If you've sold real estate during the year, if you sold a business, if you're simply just running a business and you need to figure out how that income is going to correspond or really translate to your personal tax situation. How do we plan for the potential growth there and that sort of thing. So, Greg, I'll let you chime in with situations you've seen, but it's really going to be pretty specialized, and that's the point of the meeting. Is it's not just a cookie cutter approach, right? We want to look at the whole picture and understand, where you're at, what your goals are. Where do you want to be? Somnio means to dream, right? What's your dream? Where do you want to be 5 years from now, 10 years from now, whatever that looks like, and then develop those plans to help you get there.
Yeah, perfect. I would just emphasize what we talk about all the time. Cash flow or what you need from your accounts and your investments and your real estate and your employer to live on and meet those obligations that you have to live is a lot different than income. And what do I mean by that? Well, we've got Roths, we've got money market accounts or non-qualified assets that have appreciation or don't have appreciation. And we've got traditional IRAs or tax deferred investments and annuities. And which lever does it make sense to pull, or which account does it make sense to access based upon your circumstances? And so, today I met with clients that are young accumulators and really high income earners, and we talked about, how do we reduce your tax burden. And then at the end of the day, I was talking to a couple that is nearing retirement and might hit pause on working for a couple of years. And how do we take advantage of that pause in an income stream? And what sort of scenarios might we want to look at? Roth conversions, those sorts of things are all on the table for that tax planning meeting. But again, you can't do that after January 1st for this year. And quite frankly, if you do it after about December 15th, we might go a little crazy. Any other questions out there, Pete?
No, nothing else came through. So if you do have additional questions, please don't hesitate to contact us. And I think Greg is trying to, as politely as he can, put it that get in touch with your CPA, loop us, Greg and I, in as your financial advisors if you need to. Obviously, Chris is also a resource at Somnio, but the idea is to start working on it now, get the tax planning done. So.
All right. Well, thank you all. Have a great night.
Thanks, everyone.